Apple spent 5 years promising a smarter Siri. Yesterday they finally delivered it. And the stock dropped. That's the market in 2026. Being right isn't enough. Being right at the right time is everything. Today we're unpacking exactly what happened, what's coming next, and what it all means for your trades this week. Let's get into it. Apple unveiled its long-delayed AI-powered Siri at its annual Worldwide Developers Conference yesterday in Cupertino. This was supposed to be a massive moment. Analysts had called it a pivotal event, and the iPhone maker was expected to announce a number of new AI features, including a Google Gemini-powered Siri and a dedicated standalone chatbot app. And Apple delivered exactly that. The new Siri app can revisit old conversations, work across iPhones, iPads, and Macs, and even respond to images and text visible on your screen. So why did the stock fall? Analyst Gene Munster summed it up simply: the stock drop is entirely buy the rumor, sell the news. Everything they showed was expected. Apple shares were up more than 3% intraday but turned negative during the keynote. By the close, the stock was down 0.71%, sitting at $305.15. This is one of the most important lessons in trading. Big announcements often cause the opposite reaction you'd expect. Smart money buys the anticipation, then sells into the event. The trade here isn't chasing Apple today. Goldman Sachs maintains a buy rating with a price target of $340, arguing Apple's Siri overhaul represents a systemic upgrade that could restart the iPhone replacement cycle. The longer-term thesis still holds. But the easy money on the hype trade, that's already been made. What most people don't know is that Apple's biggest catalyst this week isn't even Siri. It's something quietly happening in the background of this story. On June 8, Google officially placed orders for millions of AI chips with Intel. Boosted by that news, Intel shares opened higher and ended the day up more than 10%, trading at around $109. Intel up 10% in one day. And almost nobody was talking about it. Here's why this matters. Intel has been struggling for years. They lost ground to TSMC and Nvidia. They were the forgotten giant of semiconductors. But now, as TSMC's production capacity fails to meet market demand, Intel is securing orders from enterprises including Google. This is a rotation story. When the market leader gets too crowded and too expensive, money starts looking for the next in line. Intel could be that name. It's still cheap relative to Nvidia. It has real manufacturing assets. And it's now winning AI chip orders it wasn't winning 2 years ago. The trade idea here is straightforward. Intel had a big single-day move. Those often pull back slightly before continuing higher. Watch for a base to form around the $105 to $108 range. If it holds there on volume, that could be a clean entry for a swing trade. Meanwhile, Micron Technology rose 9.11% and SanDisk gained 6.11% on the same day. The whole memory and chip supply chain is getting a second wind. The surprising part comes next, because one company this week could either confirm this rebound, or kill it entirely. All eyes are on Oracle. Tonight is the biggest earnings report of the week. And honestly, one of the most important prints of the entire quarter. Oracle reports after the close today, Wednesday, June 10th. Analysts are expecting earnings per share of $1.96, which would be a 15.3% increase year over year. Oracle has quietly become one of the most important companies in AI infrastructure. They're not building the chips. They're building the cloud that runs on those chips. Every major AI company, from startups to the hyperscalers, needs cloud compute. Oracle has been aggressively building data centers to capture that demand. Oracle's price target was raised to $275 ahead of today's earnings, with analysts pointing to AI-driven revenue acceleration as the core thesis. The stock was already up 2% Monday on that optimism. But here's the risk. Wednesday also brings the CPI inflation print. A hot number could deepen rate hike fears and overshadow any good news from Oracle's earnings. You've got two opposing forces hitting at the same time. A great Oracle beat combined with a cool inflation number could send the market sharply higher. A hot CPI with a disappointing Oracle could be ugly. If you're finding this useful, hit subscribe right now. Every morning we break down real market moving news into real trade ideas you can actually act on. For Oracle specifically, the cleaner play is to wait for the post-earnings reaction. Let the dust settle overnight. See if the stock gaps up and holds, or gaps up and fades. Chasing earnings gaps is how beginners get burned. SpaceX plans to issue approximately 555.6 million shares at $135 per share on Friday, raising $75 billion and valuing the company at nearly $1.77 trillion. Let that number sink in. $75 billion raised in a single IPO. That would easily surpass Saudi Aramco's record $29.9 billion IPO in 2019, making SpaceX the largest initial public offering in history. And the Musk angle. At the $135 IPO price, Musk's net worth would sit at $988 billion. A 2.2% rise to $138 per share would make him the world's first trillionaire. Now here's what most people don't know about IPOs. The retail investor is always last in line. Institutions, hedge funds, and insiders get shares at $135. By the time you and I can buy, it could open at $180, $200, or higher. The first day pop has already happened before you even logged in. There are also rumors swirling that Musk may merge Tesla and SpaceX into one entity following the satellite company's public debut. If that happens, Tesla shareholders would suddenly hold a piece of SpaceX too. That's potentially why Tesla received a JP Morgan upgrade to neutral with a price target of $475. The trade on SpaceX isn't SpaceX itself on day one. The smarter play is what feeds into SpaceX. Suppliers. Infrastructure companies. The companies that build the rockets, the satellites, and the ground stations. Those don't have the IPO hype premium baked in. And they benefit from the same story. Stepping back from individual stocks. There's a bigger macro threat sitting above all of this. And if you ignore it, the individual trades don't matter. Last Friday's jobs report showed the US economy added 172,000 jobs in May, roughly double what analysts expected. Unemployment stayed flat at 4.3%. Normally a strong jobs number is great news. But right now, it's the opposite. The 10-year Treasury yield jumped to 4.54% on that news, fueled by fears the Federal Reserve might have to step in to cool a hot economy. Markets have now shifted from discussions about rate cuts toward the possibility that the Fed may need to hold rates higher for longer, or even consider additional rate increases. Markets are currently pricing in roughly a 50% chance of a Fed rate hike by the end of 2026. The easing many investors had hoped for is effectively off the table. What does that mean for you? Higher rates are bad for growth stocks. They make future earnings worth less in today's money. That's directly why high multiple tech names like Nvidia and Marvell got crushed last week. It also means the energy sector and financials look relatively more attractive. Banks make more money when rates are higher. Energy companies benefit from higher oil prices. A key line to watch on oil is $100 a barrel. Above that level, the margin drag starts hitting corporate earnings broadly. Don't fight the macro. It's bigger than any individual stock. Here's your game plan for the rest of this week. Apple sold off after WWDC as expected. The longer-term AI story remains intact, but wait for a base before buying. Goldman's target of $340 is still on the table. Intel's 10% single-day move on Google chip orders is the quiet story of the week. Watch the $105 to $108 level for a potential entry. Oracle reports today after the bell. Don't chase the gap. Wait for the post-earnings setup to form. SpaceX IPO hits Friday. Don't buy into the opening day chaos. Watch Tesla instead for a potential Musk merger play. And above all, keep one eye on yields. If the 10-year pushes above 4.6%, expect more pressure on tech across the board. Tomorrow we'll be breaking down everything that happens with Oracle's earnings tonight and the CPI print. Those two events together could set the tone for the entire summer. You don't want to miss that one. This content is for educational and informational purposes only and does not constitute financial advice. Always do your own research before making investment decisions.